Hey everyone, Tom here, coming today with another great episode. This one we are doing another market update. It's been a couple weeks, some exciting things happening in the market. A lot of them are from the US, the new administration. There's some things happening, some good, some bad, everything in between. Not going to comment, try to get too political on it, and I don't think I do in this episode, but more so saying, okay, what are the impacts for us in the mortgage market in Canada? And there are some real direct impacts. You don't think so, but very quickly it comes up and impacts this market. So we discuss all of that. We discuss some other big things happening in the mortgage market and how you can use technology to address these trends that are happening. So interesting episode for sure. We'll see you on the other side. Truth maybe is that every time you put a document in an email, that is the most vulnerable place. Hey everyone, welcome back. Today we're going to be doing another market update. This one is a little bit of mortgage, a little bit more general, what we're seeing maybe at the economy at large. But for all these things, of course, we do want to bring it back to mortgage tech. So we're going to do the best we can for that. But there's some pretty interesting big trends going at a bit more of a macro level. And so I want to make sure I address those. Let's get right into it here. There's three kind of big themes I want to talk about. For starters, I think this is something that a lot of people are aware of, but I think there was a recent thing that I've seen. The post itself is a little bit older, but it was new to me and I wanted to share it with you guys. And really it's the stats behind the renewal cliff, the renewal wall, renewal again, and whatever you want to call it, all the renewals that are coming up really in the next, call it 2 years. And really it is 2 years. So the one that I saw that came up, this is from Wawa. I don't know if they have a podcast, but they have a website. They have an Instagram account. They have a lot of great stats that they publish. I think actually recently Pierre Pauli have referenced one of their stats or studies that they did. So they have really quality data and they do a lot of good work. And yeah, as you can see here, I just pumped them up in terms of their stats. I think it's a great in terms of information. I wish it was a little bit more visual. We could see it. But what it is here is basically, this is from Q4 last year, the stats available then. Each column is one of the big 7 banks, which I think do 90% of the mortgages in Canada. And then each row is when the renewals are coming up in their book, in their portfolio. And really the punchline is this, is that if you look at the first 3 rows, for those who are actually on the YouTube channel, if you don't know our YouTube channel, please go there, check it out. It's really great to see these visuals. But if you're just listening, I'll describe it to you. Really what it says is over the next 2 years, 25, 26, 50%, half of all mortgages are going to be renewing. So yeah, it's real. I mean, all those things that people have been telling you about is, confirmed here. The idea of this renewal cliff is happening. It is going to come quick. And I think, we got to be ready for it. And so what does being ready for it mean? Well, I think with this renewal cliff, there's a couple things to keep in mind. First of all, a lot of borrowers are coming up on renewal, probably still higher rates, right? So if someone's renewing from 2020, for sure it's going to be a higher rate. From 2021, probably going to be a higher rate. If they took a 3 years ago, I was one of those people. It might be a little bit more on par. So maybe we have to worry less about those people. But for those people who are going to be coming off those much lower rates from this COVID days, for them, I basically just say, you need to get in front of them a lot quicker. It's not enough for them. If they see this big jump, they're almost for sure going to be rate shopping, right? They're not just going to see the big jump and say, hey, I'm going to take your word for it that this is the market now. They're going to validate that assumption. And on top of that, what's happening is, okay, yes, they're going to maybe be more shoppers, more people looking around. And the banks are being pretty aggressive right now. They are going out there and they are competing on rates. So, maybe that borrower banks personally with RBC, they go to their local branch, they get a great rate. And that's a tricky deal to close. So I think you just have to be aware of those people. So I'd say, bringing it back to the mortgage tech, I'd say take a look at your database, filter for those people who are coming up for renewal that did get, maybe those low rates in 2020, 2021, and start reaching out to them sooner. And really try and drive the conversation away from rate. Obviously, rate is very important. But really what you can do with that is, I would say, go from being just the transaction and go towards the trusted advisor. So don't just say, hey, this is happening. You have to sign some papers and do it. Be the advisor, right? Come in and say, okay, this thing's happening, but before you do anything, before you sign anything, let's take a step back. How are things going in your life? What, personal goals do you have? What's changed in the past 5 years? And if you can do that, you're changing the value you provide, obviously, as a broker, from just the person who can get you their mortgage and their rate, that transaction, to being someone who helps them more overall. So I'd say, yeah, bringing it back is identify those people as early as possible and then set up a cadence, make sure you're reaching out and providing that value. The other thing I'd say too with this, especially those people, if they are on a variable rate and they kind of went through the roller coaster up and down, they're still probably a little bit sore. A lot of these people might be saying, hey, I did that variable rate. It really bit me last time. I want to go to a fixed rate. And I'm not saying that variable or fixed one is better than the other. I think we just have to do our jobs as brokers and say, okay, well, yeah, there's these two things, but just because you had a bad experience over the past 5 years with a variable rate, yes, that was extraordinary times. It doesn't mean that's going to happen again. Historically, this is how these rates have compared, and just giving the clients that education to make the best decision possible. So those are the big trends I'm seeing. And I feel that now is the time to jump on it, because if you want to establish yourself as that trusted advisor, you can't just wait for a day before the renewal, right? You kind of have to help them and hold their hand through that journey. Okay, so that's number one, obviously a really important thing, and it's a trend we'll continue to monitor. Number two, this is where we kind of maybe zoom out a little bit, but I think it's also very important. This week, the Trump administration, beside OpenAI, NVIDIA, who makes the chips for OpenAI, Oracle, that's right, SoftBank, which is a big Japanese investor, they've pledged this Stargate project. I don't know if people have heard of this, but it's a pretty cool project. Already they committed $100 billion across all these different players, pooling that money together. And they say it's going to reach $500 billion over the next 4 years in investment. And really, they're just making the next level AI. And so this is really cool. I'm sharing the OpenAI website. They go into the details, the people who are backing it, the timelines, and they kind of leave it. They say, hey, all of us look forward to continue to build and develop AI, and in particular, AGI for the benefit of all humanity. So AGI is that artificial general intelligence, right? The type of intelligence that would compete head to head with humans in terms of their reasoning and all that, but of course, maybe much more knowledge and depth, and obviously resources available to them. It's kind of that monolithic. That's the big goal for a lot of these AI companies, is this AGI that can really do anything, right? So that G being general. And so it's exciting, of course. These types of things are very, very exciting. I think that's great to see that type of investment. It's great to see that people are excited to do these things. I mean, there's always a little bit of fear. And I think in maybe previous administrations, there were some fear, and I totally understand those. But I think, as I've talked about in this podcast many times, it's how you use the tools, right? It's not the tool itself that's going to be dangerous. It's how you use it. And the same applies, obviously, for this industry. It's not that this tool is going to come and wipe out all the jobs. It's going to be the people who can use these tools most effectively will be able to take their business to the next level. That's really the opportunity here. So really the point with this, and bringing it back to the technology, is these things are happening. They are moving. They're moving quick. And we're not there yet. I've worked with thousands of brokers across Canada. I don't know anyone who's implemented some AI thing today and, changed the game, was able to triple their output. That's not here yet. But maybe it could be here in the next, call it 5 years-ish. And 5 years sounds like a long time, but it's really not. What I say now is start preparing, right? You really got to start preparing, and you got to say, what feeds these AI systems? It's going to be your data. And so that's really my call to action for most people this year, is to start preparing your data. Ask yourself, can I get a list of all my clients? Okay, great. Can I get a list of all my deals? Those are things, hopefully it's a quick yes. But then start getting into it. Can I get a list of every email that I've ever sent all my clients? Can I get a list of, or a recording of every single phone call I've ever sent to my clients? These are all things that an AI can basically chew up and do something with, right? It's all food, so to speak, or oxygen for these AI systems. And so, although they're not here yet to maybe eat that meal, I'm going to continue that analogy, even though it sounds a bit weird. I think our job right now in the mortgage industry and elsewhere is to prepare that meal as best as possible, right? Have it ready to go. So when these systems come, it's very easy to feed it in. And that's how you'll be able to take advantage. So the call to action is very simple. It's just start taking a look at your systems this year. It's not an immediate thing, but it is a in the short term thing. And say, do I have a good handle on all my data? Do I have open APIs? Do I know what it means to have an open API, right? And learn about those things, because they are going to be important. I don't think it's an optional thing, right? Some people say, oh, APIs and this and that. It's too much. It's the same analogy of, I always say, probably 30 years ago, people said the same thing about emails. Emails, that's complicated. That's a computer thing. I prefer fax, and, I don't see anyone using just faxes anymore. And it's going to be the same thing, right? So you need to be able to learn these things, open API, what those mean. Make sure your systems that you use have these open APIs, and so you're best position possible to take advantage of these, really quite exciting developments that are happening. Okay, let's round out is another, semi higher level economic political type thing, but this is a really cool, I think, impact, or I say cool, but it's a little bit scary too. And what I'm referring to is tariffs. So we've all heard the threats, they're coming, they're going. I'm not going to comment on how real I think they are. Who really knows at this point? But I think what I want to talk about is Scotia came out and said, okay, well, if these are real and if Canada retaliates in the way that they say they're going to do, then what that actually means, and you can see it on the chart here, it's an interesting chart that says, okay, and I'm going to do worst case scenario. If tariffs are 25% and with retaliation, then what that means is that they think the Bank of Canada is going to have to increase overnight rate by 300 basis points, right? So that's 300 above where they are today, another 3%. That's huge, right? That's significant. Obviously, that's a huge jump. It would impact all variable rate holders. Absolutely. It would obviously affect the bond market, which would then affect the fixed rates. So I was shocked when I saw 300, right? That's a really big number. And it has a lot of downstream consequences. So we'll get to those consequences in just a sec, but I did want to give a shout out. The website I'm on is actually the Deeded website. So Reuven and their team over there, they do a lot of good job doing analysis on this type of stuff. So anybody wants to read more about it, there's a great article on this that Deeded's put together. But yeah, this chart here is showing that 300 basis points. And so yeah, talking about those downstream effects of that, it's tough to say for sure. I'd say there's two things I'd say probably we need to think about is number one, just okay, if this really happens, educating the client. That goes back to honestly what I was saying earlier about being the trusted advisor. For anybody who is looking at that variable or maybe on the variable rate, it's a great touch point, right? So being able to go into your database, filter through, say who's on the variable rate and just say, hey, FYI, who knows how likely this is, but if this is a risk, if this is something that maybe you're thinking about and you just don't want to do it, here are the options to switch from a variable to a fixed and lock in that rate so you can insulate yourself from this type of threat. Just letting people know that they can kind of make their own decision probably on how likely or unlikely it is. But I think that awareness is really good. So it's a great touch point. I would use it as that touch point to see if there is that appetite to switch. And also going back to the earlier talking about when we are recommending at renewal or whatever it is, a variable rate, saying, hey, this is something, one thing that I've heard some brokers say back in 2020 when they did recommend a variable rate and then it went through that roller coaster, they lost a little bit of sleep on it, right? And so as a broker and to really establish yourself as that trusted advisor, hang your hat on the work that you do, you just want to let people aware of this, right? So even if they do go into this variable rate and in this whatever percentage you put scenario that 300 basis points go up, you can be proud and say, for all my clients, I at least made them aware of this sort of thing. So when it does happen, it's not about blame or anything, but they can say, Tom or whoever, still have my best interest in mind. This was my choice to go in and take this risk, and I'm living with that. That's okay, but you can still maintain that relationship. So I think it's a good thing there. And then the second thing with it, this is, I think, maybe more, I think it's just my 2 cents. I don't think it's too much more than that, but we also got to think about, the likelihood of that 300 basis points increase. And this is in order to combat inflation. And so I think that, that 300, that's a huge increase. I think that it's higher than it was at its highest. I think at its highest, people were really just barely hanging on by their fingertips in some cases. And, they're really great to see that relief valve as rates started coming down. If they were to spike again, I think that's going to cause a lot of heartburn for a lot of people. And I think it's not going to be great for the real estate market. And so I think for the Bank of Canada, yes, this is what's required to combat inflation, but I think they have to decide also in this unlikely scenario, maybe putting on my tinfoil hat here a bit, but going down that rabbit hole, what's the lesser evil? This 300 basis points increase that's going to maybe really tank the real estate market, going to maybe put some people in some negative equity, or do we just let inflation kind of rip a little bit and that's going to affect everything? It's going to affect asset prices. It's going to affect everything in between. And more than likely not, I just land in the middle. They have to decide, okay, do we want this increase in the basis points or do you want to see the inflation? So it's this really interesting dynamic. The goal obviously is to strike the balance so that prices of assets don't go crazy up or crazy down, because at the end of the day, Canada is a real estate economy. So they're looking at real estate very closely. That's the ideal, is we strike a policy rate that doesn't make things go way up or way down. So we'll see. That's their goal, but it could go really either way in this one. So it'll just be a really interesting one to watch. Like I said, there's not too much of a point to that little ramble that I did there. I think it's just an interesting thing, at least for anyone in the industry to at least think about and say, is this type of increase very likely? What's that going to do downstream? And at the end of the day, policymakers, what do they have in mind and what are their goals? So that about wraps up this episode. Yeah, another market update, some big things going down at the macro level. Of course, they're starting south of the border, but like a lot of things, we get impacted pretty directly from it. So it's important to pay attention. Thanks so much for listening this week. If anybody has any other market updates, things that I might have missed, feel free to leave in the comments. I'll try to address it on the next market update episode. But until then, bye for now.